Now we will try to understand ledger posting by means of the exercise which we did earlier in respect of generalization. Let us go back and see what the exercise was about. As you see on your screen, there are so many entries which we had put through in the journal, and now whatever entries have been put through in the journal, we need to transfer them into ledgers account wise. For example, we talk about the first entry, purchase goods for cash at rupees 400. So what is the journal entry we had passed? We had passed the journal entry as purchases account debit and cash account credit with 400 rupees. So there are two accounts here which get affected. One is the purchases account, the other is the cash account. So one leg of the transaction will go to purchases account, another leg of the transaction will go to cash account. Similarly, in the second entry, we had an example of X commenced business with capital of rupees 10,000. That means we had debited cash account with 10,000 rupees because cash had come in, and we had credited capital with 10,000. So here again two accounts are affected. One is cash account, the other is the capital account. That means each leg of this transaction has to be carried forward to the respective account. So part of it will go to the cash account and the other part will go to the capital account. So how this is done? We can start with cash account, and wherever cash account is involved in all these 9 transactions, we will have to post those transactions in the cash account. So if you look at the screen, you will find that there is a cash account and the ledger folio is given. That means this account has been opened in the folio 41 of the ledger, and there we see debit on the left side and credit on the right side. There I have posted January 1 by purchases. That means we are indicating the other account which has been debited. Here cash has been credited, so it is shown on the credit side of the cash account, and the debit has gone to the purchases, so that is indicated under the particulars column as by purchases. And we also give the ledger folio of the purchases account, that is 11, so that we can easily refer this whenever there is some problem or whenever a mistake has to be rectified. And in the amount column we have put 400 rupees. Now go to the second transaction. There also cash account was involved, but the cash account had been debited there and capital account was credited. So it will go to the debit side of the cash account. So on the debit side you will see January 2 capital. That means the other account which has been credited with needs to be mentioned under the particulars column, and there also you mention the ledger folio of that particular account. That is the capital account's ledger folio is 31, that is mentioned there, and the amount involved is 10,000 rupees. Similarly, we keep on posting all entries where cash account is involved. For example, if you look at the screen, you will find on January 3 we had credited cash account, so it has come to the credit side of the cash account, and we had debited bank account, so we mentioned there by bank, and the amount is mentioned on the amount column. Similarly, next entry, furniture account was debited, so we are writing it as buy furniture under the cash account and the amount is mentioned there. Similarly, we have rent, salary and sales. All these are put. This is known as ledger posting. So this completes the posting of all entries related to the cash account. Now we can go to other accounts. For example, the other account which got involved is purchases account. So when we do the ledger posting in respect of purchases account, as you see, we first mention the ledger folio of the purchases account, that is 1 by 11. This is for reference purpose. And there, as you had seen in the cash account, one leg of cash account involved purchases. So since purchase account was debited, we are writing to cash. That means the credit has gone towards cash and the purchase account is being debited, and we write the ledger folio of the cash account, that is 31, and the amount is written in the amount column. And the other entry related to purchase of goods on credit from Z. So there the purchase account was debited and Z's account was credited. So we are writing here to Z under the debit side of the purchases account, and the ledger folio of the Z's account is also mentioned, and we write the amount. So this takes care of the purchases account. That means purchases account in our example was involved 2 times. All these 2 sides of the entries have been posted on the debit side of the purchases account. Then we go to capital account, and there was only one entry relating to capital in the entire exercise, that was in respect of cash brought in as capital. So there we had debited cash account and credited capital account. Therefore, this will appear on the credit side of the capital account, and we are writing by cash because it is the account which has been debited, and we also show the folio number of the cash account, that is 41, and against that we put that amount. Coming to the bank account, again we find that bank account was debited only once, and there were no other transactions relating to bank account, and cash had been deposited in the bank. Therefore, we had credited cash account and debited bank account. So we write here 2 cash and then give the folio number of the cash account and also the amount. Then when you come to furniture account, even this furniture account, there was only one entry where furniture was bought for cash. So we had debited furniture account and credited cash. So on the debit side of the furniture account, we post this entry as 2 cash, mentioning the folio number of the cash account and the amount. Going to sales account, we find that the entity had made 2 sales. One sale was for cash, another sale was for credit to Y. So in the first case, cash account was debited, sales account was credited, and in the other case, sales account was credited and Y's account was debited. Therefore, we write both these entries on the credit side of the sales account. In one case, we write by cash with 500 rupees, in the other case by Y, that means indicating the other account which has been debited. So this takes care of the sales account. Then coming to Y's account, there was only one entry relating to Y where the sale was made to Y on credit, and we had debited Y's account and credited sales account. So this will appear on the debit side of Y's account, and it will be mentioned as 2 sales, giving the folio number of the sales account as 21, and also the amount is mentioned there. Then coming to Z's account, Z is a person who is supplying goods to the entity. That means he is a supplier of the goods, and the entity had purchased goods on credit from Z. So we had debited purchases account and credited Z's account. So this will appear on the credit side of the Z's account by indicating that the other side pertains to purchases. So we write by purchases and write the amount there. And in the case of rent account, rent was paid by cash. So rent account was debited and cash account was credited. So under the rent account, the entry will appear on the debit side, and we will be indicating it as 2 cash as 500 rupees. Similar is the case with salary account. There the cash account was credited and salary account was debited. So we write 2 cash and put it under the debit side of the salary account as rupees 500. So now we know that whenever a ledger posting has to be done, we take into account all the entries affecting that particular account during that relevant period. That period could be one day, it could be a week, or it could be a month also. Normally postings are done on a regular basis, so normally it could be on a weekly basis or on a monthly basis, and if the volume of transactions are very high, it could be done on a daily basis also. So once we take care of all entries pertaining to that account and post them in the respective account, that will take care of the entire posting. That means what you have to remember here is, whenever a posting is done in a ledger, only one leg of the transaction is taken to the ledger posting, and there we will indicate against each entry under the particulars column the other account which has been affected by that transaction. So this will take care of the ledger posting, and once this is done, we will have to move to the third stage of the process known as summarizing. Summarizing starts with what is known as a trial balance. We will try to understand what is the meaning of trial balance, how trial balance are prepared. For that, first we will have to find out what is the balance in each of the accounts. So far we have seen that there have been postings in the accounts. For example, as you must have seen, in the cash account there were many entries. There were 5-6 entries in the cash account, and we need to know what is the balance in that account. For that, we need to balance that account. So how that balancing is done, let us try to understand. So what normally we do is, at the end of a particular period, it could be a month or a year or a fortnight or quarter, or even on a daily basis depending on the volume of transactions, we need to ascertain the balance in each account. So in the given example, we are doing it on a monthly basis. That means we have posted all entries relating to January 2012. Now we need to find out what is the balance in each account. How do you find the balance? For that, what we need to do is try to total the debit side and the credit sides, and whatever difference is there between the two sides is treated as the balance. For example, if the debit side is more than the credit side, that means the difference has to be put on the credit side, so that the totals of both the debits and credits will tally. So what does it mean? It means debit balance is in excess of the credit balance. So it is put on the credit side. Actually, it is a debit balance which has been carried down. So what we do is, we write there balance carried down and put it on the credit side, and in the next period, accounting period, that is the beginning of the next month, which we indicated as February 1, it will be taken down as balance carried forward, balance brought down and shown on the debit side. Similarly, if the credit side is in excess of the debit side, we take the difference on the debit side and write to balance carried down and then put it there, so that the totals tally, and thereafter in the next accounting period, that is the beginning of the next month, it is written as to balance brought down and put on the credit side. This is how we do. So now let us try to understand this by means of the same example where we did ledger posting. So as we seen here, the cash account is shown. So there are so many entries both on the debit side and the credit side. So what we have to do is, we have to try to balance both the sides. So we find that the balance on the debit side is more, whereas the total of the credit side is less. Therefore, as on the last day of the month, January 31st, we write the difference between the two, that is 2100, as by balance carried down, and the totals are tallied. The total comes to 10,500, and immediately at the beginning of the next period, that is February 1, we take it again back to the debit side, because that is the debit balance, because debit balance is in excess by that amount over the credit balance. So it is written as to balance brought down and shown as 2100. What does it mean? What it means is, cash account has a debit balance of 2100. That means you have cash on hand worth 2100 rupees. A debit balance in cash account always indicates the amount of money you have. If it is a credit balance, it indicates negative cash balance. Normally, cash accounts will not have negative cash balances. So normally, the debit side has to be more than the credit side. This is how the balancing of each account is done. Now let us see how the balancing can be done in respect of other accounts which we had, for which we had done the ledger posting. So going to the purchases account, there we find that purchases, there are only 2 entries. So when they are total, the total will come to 900 rupees, and since purchase is an expenditure, we have to transfer the entire balance to P&L account. There is no question of carrying it down to the next accounting year. It is taken to the profit and loss account. So there is no balance brought down or balance carried down. So here we say by transfer to P&L account. So by P&L account we write 900. That means the entire expenditure goes to the P&L account and the total are balanced. But when we are taking out the balance down as to what is the balance in the purchase account, we have to take it as 900. It is the balance which has been transferred to the P&L account. So what you have to remember here is, in the case of all nominal accounts like purchases, salary account, rent account, sales account, which are income and expense items, they need to be taken down to the P&L account, and there is no question of carrying down the balances. Only in the case of real and personal accounts, that is in the case of let us say cash account, or in the case of a bank account, or in the case of Y's account or Z account, these are real and personal accounts. The balances are carried down to the next accounting year. So capital account, you see, capital account, what is a capital account? Again, it is a personal account because it belongs to the proprietor of the entity. So here there was only one entry on the credit side, 10,000 rupees. So it is balanced by putting the difference under the debit side, writing it as to balance carried down 10,000, and the credit balance is carried down to the beginning of the next month, that is February 1, by writing it as balance brought down 10,000 rupees. So this will show a credit balance of 10,000 rupees. That means normally all real accounts and all personal accounts will show either a debit balance or a credit balance, whereas all nominal accounts like your purchases or other items of expenditure or sales or other income heads will not show any balance, and whatever balance is there has been carried down to the profit and loss account. Now coming back to the next account, bank account, this is also a real account because it is an asset, and there we had only one entry on the debit side, and so to balance that we have to put the entire amount on the credit side by writing it as balance carried down and total it up so that both the sides balance, and thereafter that amount put on the credit side has to be carried down to the debit side because the total balance in the bank account is a debit balance. Normally bank account debit balances means you have funds in your bank account, whereas a credit balance in a bank account always means that there is a overdraft in the bank account. That means you have taken a loan from the bank. So normally whenever there are no loans, all balances in the bank account need to be debit balances. Now coming back to the furniture account, this is also a real account, that is an asset account. We have only one entry on the debit side, and therefore in order to balance we have to put the corresponding entry on the credit side and write it as balance carried down, and ultimately at the beginning of the next period we show it as balance brought down at 2000. So normally all assets account are debit balances, they cannot be credit balances because an asset is always in debit balance. Now coming to sales account, as you know sales is a nominal account, it is an item of income, and normally sales accounts are always credits because it is an income, unless there is return of sale it is treated as a credit. So here we find two entries, the total of that is put on the debit side in order to balance the account, and the total is carried forward to P&L account. It is not carried down because it is a nominal account, and while jotting down the balance in the accounts you have to jot it down as 1000 credit balance in respect of sales accounts. Coming back to Y's account, again this is a personal account, so the balances need to be brought down. So here there is only one entry on the debit side, so put the compensating entry on the credit side so as to balance both of it by writing balance carried down, and in the beginning of the next period it is shown as balance brought down as 500 rupees. Same thing happens in the case of Z account, only case is Z account there is an entry on the credit side, so you have to put the balance carried down on the debit side, and ultimately at the beginning of the next period we have to show it as balance brought down on the credit side. And rent account, as we know, is a nominal account because it is an item of expenditure, and the same process has to be repeated in case of all nominal account. That means whatever balances are there need to be transferred to P&L account. So as you see, rent account also the balance is transferred to P&L account. Similarly in respect of salary account also we have transferred the balance to P&L account. So this takes the process of balancing of all the accounts, and once these balances are done we have to find out whether your entire summary of all balances tallies or not. That is done by means of what is known as a trial balance. That means we jot down all the balances which we have got in various accounts under both credit and debit sides, and since we are following the double entry system of bookkeeping, it is obvious that whatever debits are there, an equal number of credits must be there. That means the total of debit and credit must tally. So this phase is known as first part of the summarization of the accounts. So how do you prepare the trial balance? For that what we have to do is complete the closing of all accounts and jotting down the balances. The both the balances have to be jotted down, and credit will be jotted under the credit head and debit will be jotted under the debit head, indicating the account from which it has been taken. So, as you look at the screen, you find the format of the trial balance. So, it contains 5 columns as we have seen. One is the serial number, second is the ledger account, third is the ledger folio, and fourth is debit column, and the last one is the credit column. For example, let us say we try to take down the balance of the cash account. So, what you write? You write the serial number as 1, ledger account will be treated as cash account because we are taking down the balance of the cash account, and you write the ledger folio of the cash account, and under debit or credit depending on what balance is there in the cash account, you put it under that column. In the case of cash account, it is a debit balance, so you put the balance under the debit column. Suppose you are doing it with the case of furniture account. So, there again you write the serial number, then the ledger account as furniture account, and balance is normally debit. So, you put the amount under debit. So, all accounts balances are thus jotted down and then total. The total will naturally tally. And before we take up the exercise, let us try to understand what are the objectives of preparing the trial balance. Why we need to prepare a trial balance. The foremost advantage of a trial balance is that it helps in establishing the arithmetical accuracy of the books. That means we should be able to know whether there are any clerical mistakes of commission in posting or in journalizing the transactions. If there are any mistakes, they can be automatically found out by preparing the trial balance. If the trial balance does not tally, it means that there is some mistake in either journalizing the entries or in transferring those journal entries into ledger postings. And trial balance also helps in the smooth preparation of the financial statement, that is the balance sheet and the profit and loss account. So, this gives rise to preparation of the two important financial statements known as profit and loss account and balance sheet. And trial balance also gives you a summary of what has been posted in the ledgers. So, these are the objectives of preparing trial balance. And trial balance can be prepared in many ways. Most common way is to prepare the trial balance by jotting down only the balance in the accounts. There are other methods of preparing trial balance also. For example, instead of balancing the accounts, we can take the debit side total and credit side total of each of the accounts, and both are jotted down, and thereafter take the balance on the trial balance. That is called the totals method. So, but the most common method is what I have described just now, just taking out only the net balance in each of the accounts and putting it under either the debit column or the credit column depending on where it pertains to. Once that is done, then we can find out whether it balances or not. If it does not balance, then we have to find out as to what are the mistakes, where the mistake lies. So, going back to our own exercise, we can start doing this trial balance exercise. As you see on your screen, we will start with the cash account. Cash account we have mentioned, and the ledger folio of the cash account is also given. Since the net balance in the cash account was 2100, we have put it under debit balance 2100. Similarly, we go to the next account, that is purchases account. There also it was a debit balance of 900 rupees. So, put it under the debit column. In the case of capital account, it was a credit balance. So, I have put it under credit column 10,000 rupees. And similarly, bank and furniture being debit balances, they have been put under debit column. Sales account obviously is a credit balance because it is an item of income. And wise account, Z's account respectively go to debit and credit sides, and rent account and salary account of course are debit balances because they are items of expenditure. And now when you total all these, you find that the totals tally. The 11,500 is the total of the debit side and 11,500 is the total of the credit side. That means your trial balance has agreed. That means there are no mistakes in journalizing the entries as well as in posting of ledgers. But does it mean that actually there are no mistakes? Trial balance balancing is not a conclusive proof of accuracy, because what might happen is some of the errors may go undetected even after the trial balance is balanced. How can it happen? If you make the same mistake on both sides of a journal entry. That means instead of putting it as 400 rupees, if you put both debit and credit as 4000 rupees, still the trial balance will tally, isn't it? So this kind of mistakes cannot be taken care of. Or if you forget or if you omit one account altogether, instead of posting it, you don't post it at all, and still the trial balance will tally. Therefore, those in such cases, these are errors of omission. Errors of omission cannot be detected by balancing the trial balance. Similarly, compensating errors cannot be detected through the trial balance. Compensating error means an error committed in one is compensated by an error in the opposite direction in some other account, so that the net effect will not help you in trying to find out whether there has been a mistake or not. So these need to be found out separately. That of course we will see when we go to another chapter known as rectification of entries, how rectification of entries can be done, how they can be detected, and that will be taken up at a much later stage. So as I was saying, balancing of trial balance is one method of trying to detect certain mistakes, and certain mistakes cannot be detected, which will have to be found out in another way. So with this we come to the end of this session, and we will be taking up the next stage of accounting process in our next session.